It's not your imagination. The price didn't go up. Your money quietly went down. Last year, the same note in your wallet bought you a full grocery bag. Today, it hesitates halfway through the list and gives up at cooking oil. No announcement, no warning, just smaller bags, higher bills, and that strange feeling that something isn't adding up. And it isn't. Because inflation isn't just prices rising, it's a system doing exactly what it was designed to do. Right now, this matters more than ever. You feel it in fuel, in rent, in food. But the official numbers say inflation is, what, 8%, 10%, maybe 20%, depending on where you live? And yet your life feels like it got 30% more expensive. That gap? That confusion? That's where the real story begins. Let's strip it down. At its core, inflation is simple. More money chasing the same goods. But that sentence hides everything, because money doesn't just increase randomly. Someone has to create it, and that someone is usually a central bank. Imagine a small economy. There are 100 apples, and there is $100 in total, so each apple costs $1. Clean, balanced, predictable. Now, nothing changes except one thing. The money supply doubles to $200. Same apples, same farms, same trucks. But now there's twice as much money trying to buy the same 100 apples. What happens? Prices don't rise because apples got better. They rise because money got more common. Each dollar matters less. So apples go from $1 to $2. Not because apples changed, because money did. Now scale that up to the real world. Governments spend more than they collect. They run deficits. To fill the gap, they borrow. And when borrowing isn't enough, central banks step in and create new money, digitally, quietly, instantly. During crises, this accelerates. Think about 2020. Global shutdowns, economies frozen. So governments injected trillions into the system. Stimulus checks, business loans, market support. It felt necessary, maybe it was. But here's the part people don't follow through. The money stayed, even after the crisis didn't. Now combine that with something else. Supply didn't keep up. Factories slowed. Shipping broke. Energy costs surged. So now you have more money and fewer goods. That's not inflation, that's pressure. And pressure turns into prices. But here's where it gets uncomfortable. Inflation doesn't hit everyone equally. If you own assets, stocks, real estate, inflation can actually make you richer because asset prices rise with the excess money. But if you live on income, your salary moves slowly, prices move fast, so your purchasing power shrinks in real time. No headline says it like that, but that's what's happening. There's also something quieter, less visible, but just as important: expectations. When people believe prices will rise, they act differently. Businesses increase prices early. Workers demand higher wages. Suppliers lock in higher costs. Inflation starts feeding itself. Not because of money, because of behavior. It becomes a loop, and loops are hard to stop. So central banks step in again. This time not to add money, but to restrict it. They raise interest rates. Borrowing becomes expensive. Spending slows. Demand cools. In theory, prices stabilize. In reality, something else breaks. Loans get harder. Businesses slow hiring. Markets react. It's like trying to stop a speeding car by slamming the brakes. You might stop the car, but not without consequences. And here's the irony. The same system that creates inflation is also responsible for controlling it. It expands, then contracts, prints, then tightens, always reacting, rarely ahead. Now, compare the public story to the underlying reality. Public story: prices are rising because of temporary disruptions. Inflation is under control. Things will normalize soon. Underlying reality: the global money supply has permanently increased. Debt levels are higher than ever, and economies are more sensitive to interest rates than before, which means stopping inflation completely could hurt more than tolerating it. So what happens long term? Historically, inflation doesn't just disappear. It either gets controlled slowly or it forces a correction. Sometimes that correction is a recession. Sometimes it's a financial reset. Sometimes it's just years of quiet erosion, where prices keep rising, wages lag behind, and people slowly adjust their expectations downward. Not all at once, just enough to keep going. So when you ask, why won't prices stop rising, you're really asking something deeper. If the system requires constant growth, constant spending, constant expansion of money, then is inflation a problem to fix or a feature to maintain? Because if prices truly stopped rising, or worse, started falling, the entire system would have to change. And that's a much bigger risk than expensive groceries. So the next time something costs more than it should, don't just ask why the price went up. Ask what had to happen behind the scenes for your money to quietly lose value without anyone needing to tell you.